In 1790, the newly formed United States federal government assumed $75 million in debt, the combined obligations of the Continental Congress and the individual states. Treasury Secretary Alexander Hamilton argued this debt should be paid in full to establish credibility. The decision was controversial, but it worked. By honoring its obligations, the young nation gained access to credit markets and built a reputation for fiscal responsibility that lasted nearly 2 centuries. Today, in 2026, U.S. federal debt exceeds $36 trillion. Treasury Secretary Janet Yellen has reportedly warned that $38 trillion represents a critical threshold, a red line beyond which debt service costs could destabilize the entire fiscal framework. We are less than $2 trillion from that line. At current rates of deficit spending, we will cross it within 18 to 24 months. How did a nation that spent its first century meticulously managing $75 million in debt reach a point where $38 trillion is considered the boundary between manageable and catastrophic? Debt is not inherently destructive. Throughout history, nations have borrowed to fund wars, build infrastructure, and manage temporary revenue shortfalls. What distinguished sustainable debt from destructive debt was not the amount, but the relationship between debt and the capacity to repay it. The British Empire in the 19th century provides an instructive example. Following the Napoleonic Wars, British national debt reached over 200% of GDP, one of the highest levels in history to that point. Yet Britain did not collapse. It did not default. It did not hyperinflate. Instead, it ran budget surpluses for decades, gradually paying down the debt while its economy grew. By the 1850s, the debt-to-GDP ratio had fallen below 100%. The key was that the debt was incurred for a specific purpose, winning an existential war, and once that purpose was achieved, fiscal discipline was restored. The debt was also held domestically and denominated in a currency backed by gold. Creditors understood that British pounds could be exchanged for a fixed quantity of gold. This meant the government could not inflate away its obligations. It had to either repay the debt through taxation and surpluses or default. The gold standard imposed discipline that made default politically unacceptable and inflation mathematically impossible. So Britain chose austerity, and the system survived. The United States followed a similar pattern through most of its history. Debt rose during wars, the Revolutionary War, the War of 1812, the Civil War, World War I, World War II, but fell during peacetime as surpluses were directed toward debt reduction. After World War II, U.S. debt peaked at 106% of GDP in 1946. By 1974, it had fallen to 23%. This reduction occurred not through defaults or currency debasement, but through economic growth and fiscal restraint. This historical pattern reveals a critical principle. Debt sustainability depends on the credibility of repayment. Credibility comes from either a demonstrable ability to repay through growth and surpluses, or from a monetary system that prevents the government from inflating away obligations. When both are absent, debt becomes unsustainable regardless of the nominal amount. The Roman Empire learned this through gradual collapse. Roman debt was not denominated in fixed terms, but its currency was, initially. The denarius contained a specific quantity of silver, but as imperial expenses grew, emperors debased the currency, reducing silver content to fund spending without raising taxes. This was functionally equivalent to inflating away debt. And it worked temporarily. Soldiers were paid, construction continued, and the empire functioned. But debasement destroys credibility. Merchants began demanding more debased coins to compensate for reduced silver content. Prices rose. The government debased further to keep up with rising costs. By the 3rd century AD, the denarius contained less than 5% silver, down from 95% 4 centuries earlier. The currency still circulated, but it no longer functioned as a reliable store of value or medium of exchange. Trade contracted. Tax collection became impossible. The fiscal system collapsed, and the political system followed within decades. The critical insight is that Rome's collapse was not caused by excessive debt in the abstract. It was caused by the loss of credibility in the mechanisms meant to manage that debt. Once the currency was no longer trusted, the empire could not fund itself through taxation, could not borrow credibly, and could not maintain the administrative and military apparatus that held the territory together. Debt became the trigger, but currency debasement was the underlying cause. Ancient China experienced similar patterns. The Song dynasty, which ruled from 960 to 1279 AD, faced constant military pressure from northern tribes. Defense was expensive. Rather than raise taxes to unsustainable levels, the government issued paper currency, jiaozi, backed by reserves of copper and precious metals. Initially, the system worked. The paper was convertible to metal at fixed rates, so it circulated as trusted money. But war expenses continued to mount. The government printed more jiaozi than it had reserves to back. For years, this went unnoticed because most people didn't attempt to convert paper to metal. They simply used the paper for transactions. But eventually, enough people tried to convert that the reserve inadequacy became apparent. Confidence collapsed. The currency depreciated rapidly despite government decrees mandating acceptance at face value. By the time the Song dynasty fell to the Mongols, its currency was functionally worthless. The pattern repeats. Debt can be managed as long as the currency used to denominate it remains credible. When currency credibility erodes, whether through debasement, overissuance, or broken convertibility promises, debt becomes unpayable in real terms, even if it remains payable in nominal terms. And once that reality becomes apparent, the entire fiscal structure collapses. The modern debt system was not designed intentionally. It emerged from a series of crises, each of which broke constraints that had previously limited debt accumulation. The first constraint was gold. Under the classical gold standard that prevailed from the 1880s through World War I, governments could only borrow what creditors were willing to lend, and creditors demanded gold-backed currencies, or gold itself, as repayment. This created a natural ceiling on debt accumulation. If a government borrowed too much, its gold reserves would drain as creditors demanded payment in metal rather than paper. This forced either austerity to rebuild reserves or default. World War I shattered the system. The cost of the war exceeded all participants' gold reserves many times over. Governments suspended gold convertibility to print currency for war funding. Britain, France, Germany, Russia all left the gold standard during or immediately after the war. What was presented as a temporary emergency measure became permanent structural change. The 1920s and 1930s saw chaotic attempts to restore gold-based monetary systems. Britain returned to gold in 1925 at the pre-war exchange rate, which overvalued the pound and triggered economic contraction. The Great Depression forced most nations off gold again as they pursued independent monetary policies to combat deflation. By the mid-1930s, the gold standard was effectively dead except for limited international settlements. World War II required even greater government spending than World War I. The United States alone spent over $300 billion, roughly 35% of GDP at its peak in 1945. This was financed through taxation, bond sales, and monetary expansion. Total U.S. debt reached $260 billion by 1945, or 106% of GDP. Under a strict gold standard, this level of borrowing would have been impossible. But by 1945, the gold standard was already dead domestically. Gold remained only as a backing for international currency settlements. The Bretton Woods system, established in 1944, attempted to split the difference. The U.S. dollar would remain convertible to gold at 35 per ounce for foreign central banks. Other currencies would peg to the dollar. This created a partial gold standard, not for individuals, but for governments. It was meant to provide the discipline of gold while allowing the flexibility of managed currencies. But Bretton Woods contained a fatal flaw identified by economist Robert Triffin in 1960. For the system to work, the world needed an ever-increasing supply of dollars to facilitate growing trade. But increasing the dollar supply meant issuing more claims against a fixed gold reserve. Eventually, the claims would exceed the gold available to redeem them, making the promise of convertibility unsustainable. By the 1960s, this contradiction was becoming acute. The U.S. was running persistent deficits to fund the Vietnam War and domestic spending programs. Dollars flooded overseas. Foreign central banks accumulated these dollars and increasingly began exchanging them for gold. U.S. gold reserves fell from over 20,000 metric tons in 1950 to under 10,000 metric tons by 1970. France, under Charles de Gaulle, systematically drained U.S. gold by demanding conversion of dollar reserves. De Gaulle publicly questioned why France should hold depreciating paper dollars when it could hold gold. Other nations followed. The gold drain became unsustainable. By August 1971, the United States held approximately $10 billion in gold reserves against over $50 billion in foreign-held dollar claims. Simple mathematics showed that full convertibility could not be maintained. On August 15, 1971, President Richard Nixon announced the temporary closure of the gold window. Dollars would no longer be convertible to gold, even for foreign governments. This was described as a temporary measure to stop speculation. It became permanent. The Bretton Woods system was dead. For the first time in modern history, the global monetary system operated on pure fiat currency, money backed by nothing except government decree and the willingness of others to accept it. The immediate consequence was currency chaos. Exchange rates floated. Gold prices soared from $35 to over $800 per ounce by 1980. Oil prices quadrupled as OPEC nations recognized they were being paid in depreciating currency. Inflation in the United States accelerated from under 3% in the 1960s to over 13% by 1980. But the long-term consequence was more significant: the removal of the final constraint on debt accumulation. Without gold convertibility, governments could borrow without worrying about reserve drainage. Central banks could monetize debt by purchasing government bonds with newly created currency. The only constraints were political will and inflation tolerance, and both proved far more flexible than gold reserves had ever been. U.S. federal debt was $398 billion when the gold window closed in 1971. roughly 34% of GDP. Politicians and economists at the time worried this was dangerously high. Today, it exceeds 36 trillion, or roughly 129% of GDP. In nominal terms, debt has increased by a factor of 90. In real inflation-adjusted terms, it has increased by a factor of 15. The removal of gold backing didn't immediately cause debt explosion, but it removed the mechanism that had prevented it. The same pattern occurred globally. Japan's debt-to-GDP ratio has reached 260%. Italy's exceeds 140%. Greece exceeded 180% before its crisis. These levels would have been mathematically impossible under gold-backed systems because creditors would have demanded gold long before debt reached such extremes, forcing either default or austerity. Under fiat currency, debt can grow until creditors lose confidence in the currency itself, a threshold that is higher, but once crossed, far more catastrophic. The shift from gold-backed to fiat currency did not eliminate debt constraints. It merely changed them from mathematical limits imposed by finite gold reserves to psychological limits imposed by creditor confidence. And confidence, unlike gold reserves, is not measurable until it breaks. The mathematics of the current U.S. debt situation are not complicated. They are simply unsustainable. U.S. federal debt as of early 2026 stands at approximately $36.2 trillion. This represents roughly 129% of GDP, which is measured at approximately $28 trillion. Debt has grown at an average annual rate of 8.1% since 2000, while nominal GDP has grown at 4.2%. When debt grows nearly twice as fast as the economy, the ratio escalates regardless of economic growth. But the absolute level of debt is less significant than the cost of servicing it. In 2020, when interest rates were near zero, the federal government paid approximately $345 billion in interest on $27 trillion in debt, an effective rate of 1.3%. By 2024, with debt at $34 trillion and rates significantly higher, interest costs reached approximately $880 billion, an effective rate of 2.6%. Current projections for 2026 suggest interest costs will exceed $1 trillion, or roughly 3.5% of GDP. To put this in perspective, in 2026, the federal government will spend more on interest payments than on national defense, which is budgeted at approximately $850 billion. Interest costs now exceed all discretionary spending categories except defense. They exceed spending on veterans' benefits, education, and infrastructure combined, and they are growing faster than any other budget category. The cause is straightforward. Approximately $9 trillion in U.S. Treasury debt will mature and require refinancing over the next 3 years. Much of this debt was issued between 2009 and 2021 at interest rates between 0.5% and 2%. It must now be refinanced at rates between 4% and 5%. This means the government's annual interest burden will increase by approximately $200 to $300 billion as this refinancing occurs, even if no new borrowing takes place and rates don't rise further. But new borrowing is occurring. The federal deficit for fiscal year 2025 was approximately $1.9 trillion. This means the government borrowed $1.9 trillion beyond what it collected in taxes. That new debt must be serviced at current interest rates, which adds another $80 to $95 billion in annual interest costs. And the cycle compounds. Deficits require borrowing. Borrowing increases debt. Increased debt raises interest costs. Higher interest costs increase deficits, requiring more borrowing. This is what Janet Yellen reportedly identified as the $38 trillion red line. At $38 trillion in debt with current interest rates, annual interest costs would likely exceed $1.2 trillion. At that point, interest costs alone would consume roughly 18 to 20% of total federal revenues, which are approximately $4.9 trillion. When 1/5 of all revenue goes solely to interest payments, not to defense, not to Social Security, not to any government service, the fiscal structure becomes critically fragile. Historical precedent suggests that when interest costs exceed 15 to 20% of government revenue, fiscal crisis becomes highly probable. Italy crossed this threshold in the 1990s and required IMF intervention. Greece crossed it in 2009 and experienced sovereign default and economic collapse. Argentina has crossed it repeatedly and suffered recurring currency crises. The United States is approaching this threshold not as a small, peripheral economy, but as the issuer of the global reserve currency. There is no precedent for what happens when the reserve currency issuer reaches debt unsustainability. The debt maturity profile makes the situation more precarious. Of the $36 trillion in outstanding debt, approximately $8.4 trillion matures within 1 year. Another $3.2 trillion matures within 1 to 3 years. This means roughly $11.6 trillion, to nearly 1/3 of all outstanding debt, must be refinanced or rolled over within 3 years. If interest rates remain elevated or rise further, the refinancing cost will surge. If creditors become reluctant to roll over maturing debt, the government must either find new buyers or monetize the debt through Federal Reserve purchases. Foreign holdings of U.S. Treasury debt have plateaued and, in some cases, declined. China's holdings peaked at over $1.3 trillion in 2013 and have fallen to under $800 billion as of late 2025. Japan's holdings have remained relatively stable but are not growing. Combined, China and Japan, the two largest foreign holders, now hold approximately $1.9 trillion, down from over $2.4 trillion at the peak. This reduction of $500 billion in foreign demand means the debt must be absorbed elsewhere, either by domestic buyers or by the Federal Reserve. The Federal Reserve's balance sheet, which stood at $4.5 trillion before the pandemic, expanded to over $9 trillion during 2020 and 2021 as the Fed purchased treasuries and mortgage-backed securities to stabilize markets. The balance sheet has since declined to approximately $7 trillion through quantitative tightening, but it remains nearly twice the pre-pandemic level. If foreign demand continues to weaken and domestic private demand proves insufficient, the Fed may be forced to resume purchases, effectively monetizing the debt. Money supply data reflects this monetization history. N2 money supply was approximately $15.5 trillion in early 2020. By April 2022, it had surged to $21.7 trillion, a 40% increase in roughly 2 years. This expansion was primarily driven by Fed purchases of government debt and the resulting increase in bank reserves and deposits. The money supply has since contracted slightly to around $21 trillion, but this contraction has coincided with rising interest rates and declining asset prices, conditions that historically precede financial stress. Corporate debt levels compound the systemic risk. Total U.S. corporate debt exceeds $11 trillion, much of it issued at low rates between 2010 and 2021. As this debt matures and must be refinanced at 7 to 10% rates instead of 2 to 4% rates, corporate interest costs will surge. Companies that were marginally profitable with low debt service costs will become unprofitable with high debt service costs. Default rates, which have already risen from under 2% in 2021 to over 5% in late 2025, will likely continue climbing. The bond market is pricing these risks through elevated yields and steepening curves. The 10-year Treasury yield remains above 4.5% despite Fed rate cuts. The 30-year yield exceeds 5%. These yields reflect either persistent inflation expectations, credit risk concerns, or both. Under a gold standard, yields this elevated would trigger gold outflows and force fiscal adjustment. Under fiat currency, they simply signal that markets are demanding higher compensation for the risk of holding long-duration government debt. State and local government debt adds another $3.2 trillion to the total. Household debt exceeds $17 trillion. Student loan debt approaches $1.7 trillion. When combined with federal and corporate debt, total U.S. debt exceeds $70 trillion against a GDP of $28 trillion, a ratio of 2.5 to 1. This is not immediately catastrophic. Japan has sustained higher debt levels for decades, but Japan's debt is held almost entirely domestically, denominated in yen, and financed at near zero rates by a captive banking system. U.S. debt is held significantly by foreign creditors, must be financed in competitive global markets, and is subject to rate volatility. The sustainability models are different. What the numbers reveal is not an immediate crisis, but a trajectory that becomes unsustainable within a definable time frame. At current deficit levels of $1.8 to $2 trillion annually, debt will reach $38 trillion within 18 to 24 months. At that point, assuming interest rates remain near current levels, interest costs will exceed $1.2 trillion, consuming 20% of revenue. If rates rise, the threshold arrives sooner. If deficits increase, the threshold arrives sooner. The math is not speculative. It is arithmetic. Markets do not wait for crises to become official before pricing them in. They signal stress through price, volume, liquidity, and behavior changes that appear months or years before the crisis becomes undeniable. The first signal is the persistent elevation of long-term Treasury yields. Despite Federal Reserve attempts to control them, the Fed controls short-term rates directly through the Fed funds rate. It influences long-term rates indirectly through bond purchases and forward guidance. But since 2023, long-term yields have remained stubbornly high, even as the Fed cuts short-term rates. In a normal environment, when the Fed cuts rates, long-term yields fall in anticipation of slower growth and lower inflation. But the 10-year Treasury yield has not followed this pattern. It briefly fell below 3.5% in late 2023, but has since risen back above 4.5%, despite Fed cuts totaling 100 basis points. The 30-year yield remains above 5%. This suggests bond markets are pricing in either persistent inflation expectations or increasing credit risk, potentially both. This divergence between short-term and long-term rates signals that markets do not believe the Fed's inflation fight is over, or that they are beginning to price in sovereign risk premiums for U.S. debt. Historically, Treasury debt has been considered risk-free. The yield on Treasuries represented the time value of money, not default risk. But when long-term yields remain elevated despite short-term rate cuts, it suggests markets are demanding additional compensation beyond the time value, compensation for risk. The second signal appears in Treasury auction dynamics. The U.S. Treasury conducts regular auctions to sell new debt and refinance maturing obligations. These auctions are typically oversubscribed, meaning demand exceeds supply. But the bid-to-cover ratios, the amount of bids received relative to the amount offered, have been declining for longer-dated securities. The 10-year note auctions in late 2025 saw bid-to-cover ratios averaging 2.3 to 2.5, down from averages above 2.7 in previous years. The 30-year bond auctions have seen similar declines. More concerning is the increasing share of indirect bidders, a category that includes foreign central banks, which has fallen from approximately 70% in the 2010s to under 60% in recent auctions. This indicates declining foreign demand, which must be offset by increased domestic or Federal Reserve purchases. When auction demand weakens, yields must rise to attract buyers. This is already occurring. The Treasury is paying more to borrow than at any time since 2007. And as yields rise, the cost of servicing the debt increases, which increases deficits, which requires more borrowing, creating a self-reinforcing cycle. The third signal is in the currency markets. Despite elevated Treasury yields, which should attract foreign capital and strengthen the dollar index has shown unusual volatility and periodic weakness. The dollar remains strong against the euro, yen, and pound, but this reflects weakness in those currencies rather than underlying dollar strength. More significantly, central bank reserve diversification continues. Dollar-denominated reserves have declined from 71% of global reserves in 2000 to approximately 58% as of 2024. This diversification is occurring gradually but persistently. Central banks are not dumping dollars, but they are allocating new reserve accumulation toward gold, yuan, and other alternatives. Over time, this reduces structural demand for Treasury debt. Gold prices provide the fourth signal. Gold has reached all-time nominal highs above $2,700 per ounce, despite real interest rates being positive. Traditionally, gold struggles when real rates are high because the opportunity cost of holding non-yielding gold increases. But gold has been rising alongside elevated real rates, suggesting buyers are motivated by systemic risk concerns rather than yield comparisons. Central bank gold purchases have remained strong for 14 consecutive years through 2025. Total official gold reserves exceed 36,000 metric tons. China, Russia, Turkey, India, and Poland have been aggressive buyers. These purchases are occurring quietly, without fanfare, but the message is clear. The institutions responsible for managing currency systems are diversifying away from fiat reserves into hard assets that cannot be debased or defaulted on. Silver inventories provide the fifth signal. COMEX registered silver available for delivery against futures contracts, has fallen from over 350 million ounces in 2020 to under 40 million ounces in late 2025. This represents a drawdown of nearly 90%. Meanwhile, industrial demand for silver continues growing 15 to 20% annually, driven by solar panels, electric vehicles, and electronics. The paper silver market, futures contracts traded on exchanges, vastly exceeds physical supply. Estimates suggest paper claims outnumber physical ounces by ratios exceeding 100 to 1. This creates a situation where, if even a small percentage of contract holders demand physical delivery, the exchange cannot fulfill the obligation. Historically, this type of disconnect between paper and physical markets has preceded sharp repricing events. Credit markets are signaling stress through widening spreads and bifurcating access. Investment-grade spreads remain relatively stable, but high-yield spreads have widened significantly. The spread between high-yield corporate bonds and treasuries now exceeds 500 basis points for lower-rated issuers, levels typically seen during or approaching recessions. Leveraged loan markets are experiencing rising distress. Covenant-light loans issued during the low-rate era are now being restructured or extended as borrowers struggle to refinance at higher rates. Private credit markets, which grew explosively from 2015 to 2022, are experiencing their first real stress test. Anecdotal evidence suggests significant markdowns and defaults are occurring, but not being reported publicly due to the opaque nature of private markets. Commercial real estate provides another stress signal. Office property values have declined 30 to 50% in major markets since 2022. Occupancy rates remain 30 to 40% below pre-pandemic levels. Approximately $1.5 trillion in commercial real estate debt matures between 2024 and 2027, Much of this debt is underwater. The property value is less than the loan amount. Banks holding this debt are either extending loans at lower valuations or facing losses. Regional banks in particular have significant commercial real estate exposure and face mounting stress. All of these signals share a common characteristic. They indicate that the system is functioning, but only through continuous intervention and support. Remove the Federal Reserve backstops and repo markets freeze. Remove regulatory requirements, forcing banks to hold treasuries, and auction demand weakens. Remove intervention in currency markets and volatility surges. The system operates, but it does not self-stabilize. It requires constant management to prevent dislocations from cascading. This is the signature pattern of a system approaching limits. Not catastrophic failure, but persistent stress requiring escalating intervention. Each intervention succeeds temporarily, but creates conditions requiring future intervention. The cycle is self-reinforcing and unsustainable, but the endpoint remains uncertain in timing, even as it becomes certain in direction. History provides no example of a global reserve currency issuer reaching debt unsustainability, because no previous reserve currency operated on pure fiat money. The British pound was backed by gold during its reserve currency period. The dollar itself was backed by gold until 1971. We are in unprecedented territory. A fiat reserve currency with debt levels that would have triggered gold outflows and forced adjustment under previous systems. But history does provide examples of what happens when governments lose the ability to service debt credibly. And the patterns are consistent across centuries and continents. The first consequence is the loss of fiscal flexibility. As interest costs consume an increasing share of revenue, the government loses the ability to respond to crises or fund discretionary programs. In the 1990s, Italy's interest costs exceeded 20% of revenue. The government could not increase spending without triggering market panic. It could not cut spending without triggering political crisis. It was trapped between fiscal necessity and political impossibility. The United States is approaching this trap. If interest costs reach $1.2 trillion, while revenue remains near $5 trillion, 24% of revenue will go solely to interest. This leaves $3.8 trillion for everything else: defense, Social Security, Medicare, Medicaid, veterans benefits, infrastructure, education, and all other government functions. These mandatory and politically protected spending categories already exceed $3.5 trillion. The math leaves virtually no room for discretionary spending or crisis response. If a recession occurs, tax revenues will fall as unemployment rises and corporate profits decline. Spending will increase due to automatic stabilizers like unemployment insurance and food assistance. The deficit will surge. More debt must be issued. Interest costs will rise further. The government will face a choice: cut spending during a recession, worsening the economic contraction, or borrow massively, risking a sovereign debt crisis. The second consequence is the risk of forced monetization. If Treasury auctions begin to fail, if there are not enough buyers at prevailing yields, the government faces three options: raise yields dramatically to attract buyers, default on obligations, or have the Federal Reserve purchase the unsold debt. The first option triggers economic contraction. The second option destroys credibility and potentially the reserve currency status. The third option is inflationary but politically expedient. History suggests governments always choose the third option when faced with this trilemma. The Fed will purchase treasuries rather than allow auction failures. This is not speculation. It is what happened in 2020 when markets seized up, and it is what happened in 2008 during the financial crisis. The Fed's mandate includes financial stability, and Treasury market dysfunction threatens stability more acutely than inflation. But monetization comes with costs. When central banks purchase government debt with newly created money, it increases the money supply. If this money flows into the real economy rather than sitting in bank reserves, it shows up as consumer price inflation. The United States has been able to avoid this outcome historically because dollars created through Fed bond purchases largely remained in financial markets or flowed overseas. But as reserve diversification continues and foreign demand weakens, newly created dollars have fewer places to go except into domestic prices. The third consequence is currency depreciation. If the Fed monetizes debt on a large scale, dollar holders will anticipate inflation and seek to reduce exposure. Foreign central banks will accelerate reserve diversification. Private holders will shift to real assets. The dollar will weaken, not suddenly, but persistently, in a way that becomes self-reinforcing. Weakness validates the decision to sell. More selling causes more weakness. This does not necessarily mean hyperinflation. The U.S. economy is large and productive. The dollar is deeply embedded in global trade and finance. Transition away from dollar dominance will take years, possibly decades. But persistent inflation of 5 to 10% annually would destroy purchasing power by half in 7 to 14 years. Over a generation, savings would be effectively confiscated through currency debasement. The fourth consequence is political instability. Debt crises are not primarily economic events. They are trust events. When populations realize that government promises, pension payments, social security benefits, healthcare coverage cannot be met without inflating away the currency, trust in institutions collapses. This manifests in political polarization, protests, strikes, and the rise of populist movements promising radical solutions. The fiscal crises in Greece, Argentina, and Lebanon all followed this pattern. Economic stress led to political chaos. Governments fell. Radical parties gained power. Social cohesion fractured. The United States is not immune to this dynamic. A debt crisis that forces cuts to Social Security, Medicare, or defense spending would trigger political upheaval on a scale not seen since the Civil War. The fifth consequence is geopolitical realignment. The dollar's reserve currency status grants the United States geopolitical power. It allows sanctions to be enforced. It enables military spending far beyond what tax revenue alone could fund. It creates demand for dollar-denominated assets that keeps borrowing costs low. If the dollar loses reserve status, not completely, but partially, the United States loses these advantages. China, Russia, and other nations are already building alternative payment systems to bypass dollar dominance. The BRICS nations are exploring reserve currency alternatives. Saudi Arabia is discussing oil sales in currencies other than dollars. These efforts have been marginal so far, but a U.S. debt crisis would accelerate them dramatically. If holding dollar reserves becomes perceived as risky, nations will diversify rapidly, and the feedback loop will be unstoppable. History shows that reserve currency status is lost not through sudden replacement, but through gradual erosion of confidence, followed by accelerating diversification. The British pound lost reserve status over decades, not overnight. But once the process began, it was irreversible. The dollar could follow the same trajectory if debt sustainability is not restored. The final historical lesson is that debt crises are resolved through one of four mechanisms: growth, austerity, default, or inflation. Growth allows debt to be serviced without cutting spending or raising taxes. But U.S. growth rates have been insufficient for decades. Austerity means cutting spending or raising taxes to generate surpluses. But this is politically implausible and economically contractionary. Default means refusing to pay obligations, which would destroy the reserve currency status and trigger global financial chaos. That leaves inflation, slowly debasing the currency to reduce the real value of debt. Inflation is the path of least political resistance. It does not require congressional votes to cut popular programs. It does not require explicit default that would destroy credibility. It simply requires allowing the currency to depreciate while making nominal debt payments. This is what Rome did through debasement, what China did with paper money, what Weimar Germany did in the 1920s, what Argentina and Turkey are doing now. The United States has more tools and more time than smaller economies, but it faces the same mathematical constraints, and mathematics, in the end, is implacable. Janet Yellen's reported warning that $38 trillion represents a red line is not alarmism. It is arithmetic. At $38 trillion with current interest rates, the cost of servicing debt will consume 1/5 of all federal revenue. At that point, the government loses fiscal flexibility, becomes dependent on continuous Fed support, and risks triggering the loss of confidence that turns manageable debt into crisis. We are less than $2 trillion from that threshold. At current deficit rates, we will reach it within 2 years. This is not distant future risk. This is immediate trajectory. Alexander Hamilton established American fiscal credibility in 1790 by honoring $75 million in debt. That credibility, built over 2 centuries, is now being tested by $36 trillion, an amount 480,000 times larger. The debt itself is not unprecedented as a ratio of GDP. Other nations have sustained higher levels, but the United States is the reserve currency issuer. There is no lender of last resort above the Federal Reserve. There is no external bailout. The only options are internal: growth, austerity, default, or inflation. History shows which option is always chosen, and the mathematics show how much time remains before the choice becomes unavoidable. This is not prediction. This is trajectory. And trajectories, once established, require force to alter. The question is not whether the red line exists. The question is whether the political system can generate the force needed to change direction before the line is crossed. The numbers suggest the answer, and the answer is unsettling.